All right, so welcome to our webinar today on upcoming tax law changes. My name is Dan Nicholson. I'm the founder and CEO of Nth Degree CPAs. I've got Kyle Boggie who's also a CPA and really leads our tax practice. And I'm very happy to share that he's been with me for maybe more than a decade, or right around a decade at this point.
Right there, yeah.
I think those of you that have talked to me recently and maybe talked to Kyle recently, I would say that Kyle has definitely eclipsed me in terms of technical tax knowledge. You might add several other things in addition to that. But for now, for the sake of my ego, I'll just say technical tax knowledge, and then Kyle can dunk on me later as we go through this presentation. One thing I want to highlight, some of you that tuned in for our webinar about instant IP. You notice on each of these slides, we have this little thing about how our slides, our IP, are protected by its instant IP. And at some point, I'll share a link to the webinar we did last week if any of you want to go back and check it out. But I believe that the biggest risk facing business owners right now is, especially in the face of AI, is protecting their intellectual property. And instant IP is a great solution for that. So as you're probably aware, the House passed the quote unquote, the one big beautiful bill last week on the 22nd. This is not officially tax law at this point because the Senate has to approve it. The president has to sign off on it. And so I think most people's point of view is that the Senate's likely to make modifications. We don't know what those will be at this point. And frankly, this is not a politics webinar, so we're not going to comment on whether this bill is good or not. We're not going to comment on the impacts to the deficit. We're not politicians. We don't have expertise in that area. I joke that my politics is capitalism, and so our job is to help you all be armed and prepared to understand this legislation as best as we can. With that, some might argue that it's good news that the Senate hasn't yet provided a timeline for when they're going to vote on the bill. Why is it good news? Well, that means you still have some time to get yourself in a position of readiness. We'll talk about later how bonus depreciation is going to go from 40% back to 100%. And what exactly does that mean? Well, if one of your strategies is long-term or short-term rentals, one reasonable point of view is that the reason why bonus depreciation, these incentives are created, is to incentivize more people buying real estate and equipment, other depreciable assets. Said another way, these tax law changes may stimulate additional buyers into the market, into the short-term rental, long-term rental space. So it's good news that maybe we have a little bit more time for you to get yourself in a position to execute on some of these strategies and/or start acquiring properties now before the market heats up a little bit more. So that's sort of maybe this is good news that we don't know exactly when this is going to go live. You can get yourself a bit better positioned and be a bit opportunistic. Now, major themes of the legislation, in a moment I'm going to hand it over to Kyle to talk specifics. No tax on tips, overtime, car loan interest, or some examples of some individual relief. On the business side, I just talked about some of the enhancements around expensing, both depreciation, RD credits, some manufacturing benefits. And then there's some shifts in some of the energy policies and some things that are going to be going away. So you may want to, again, be opportunistic, and if that was part of your plan, to capitalize on those before the credits sunset. Now, a number of you who have tuned in today aren't currently clients of Nth Degree, and you don't have to be a client to participate in this webinar, so we're not about to kick you off. But if you're thinking that after this webinar that you would like to learn more about our firm, our focus is primarily on growth-focused business owners and/or high-income earning W-2 owners with at least $400,000 in annual taxable income. And you're tired of traditional accounting solutions, what we call archaeologists, those who are focused on the past. To minimize your taxes, you have to be future focused. You have to be implementing based off your goals, based off the changes in the tax code. And your business and money in general should help you live the life that you want. So why do I care about tax law changes? Why do I care about tax planning? It's an opportunity to recover your biggest expense and reallocate it to funding the goals that you have, rather than having to work harder to make another 200,000. Recover those funds, and just think about if you have a 10% profit margins to make another 200 grand, you got to generate $2 million more in additional revenue times 10% to get that 200 grand. Think about all the risk and effort that goes into that. More product you've got to purchase, more employees you need to hire, maybe more locations you need to rent if you're a real estate business. So more, there's effort and risk associated with that. So there's a lot of asymmetry to the upside, to use a technical term, in minimizing your tax exposure. So that's why I'm personally so interested in this, because I think it helps people live the life they want faster. Now, there's some essential questions, because tax planning is really not for everyone. I think people on this call probably is for you, but you have to want to turn your money into things that have long-term benefit. That may seem obvious. Why wouldn't I want to turn my money into things that have long-term benefit? But oftentimes folks are so focused on today, just funding today, that their cash is tied up or already spent in some respects. I'm sure you know some folks who are ostensibly living paycheck to paycheck. And there's this whole idea of Parkinson's law: you make more, you spend more. And so they're not able to turn things into a long-term benefit. Next question: are you willing to learn new things, even if it means changing your mind? And do you want to learn how to take smart risks? I can't tell you the number of times that I get on calls with prospects and they're like, yeah, this sounds great, but my friend's not doing this. So is this really real? Because my friend isn't doing it. And then they don't end up implementing. And in part, it sort of points to they're not really ready to learn new things and not really ready to change their mind. Frankly, the education system does not teach you how to minimize your taxes. You can get a master's in tax. Kyle and I can speak to taking master's in tax classes. You can get an undergrad. You can take the CPA exam. None of that teaches you how to minimize your taxes. Our team is largely comprised of folks who've worked at other top 100 firms, big four firms, lots of expertise and experience when they join our team. And I think they would tell you that in their previous experiences, they didn't learn how to minimize taxes. They learned how to do compliance, and they're great at it. But in other words, even an accounting degree or a master's in tax is not teaching you how to minimize your taxes legally and ethically. So why would you know these rules? Now, we've been doing this for 15 years. 15 years ago, there really wasn't anyone in the space that I was aware of leading with tax planning. And what I found in recent years is that there are a lot more folks, but they're leading with tactics, and that are the least amount of effort for them to implement. They're just trying to show you savings quickly, even if it gets you further away from their goals. And they don't have a overarching philosophy or strategy, but you can't solve a strategic problem with tactics. So when you do tax planning, you need to have a philosophy. First, we need to get your entity, and I've got the technical language behind our philosophy, and I'm just going to make it plain language for all of you. First, we have to get your entity structure correct. And as we talk later about some of these new provisions, some of them may change the way that your entities are currently structured. So there may be some opportunities to make them more efficient for you. So we first want to get that right. And there's some other factors like privacy and legal liability that we want to consider. Then we want to implement any of these, what I call low-hanging fruit strategies that require minimal effort, or maybe they require some effort, but the upside, the asymmetry is so significant that it's worth your effort. The sort of average hourly rate is so massive that it's worth your time. And the documentation can be completed while maintaining positive cash flow. So in other words, to sustain these strategies, you're not creating a new job for yourself, or it can be outsourced to people like my team to do with still a significant positive cash flow to you. Then, so we've captured all the low-hanging fruit stuff you already qualify for. Then we need to make sure we understand your cash flow requirements. How much liquidity do you have right now? In other words, how much cash do you have on hand and how much do you need in the future? So before we implement any strategies, we need to get an understanding of your overall cash flow position. Then we need to consider any strategies that would unlock what are called unutilized tax benefits, basically things that are on your return that have been like trapped credits, trapped deductions, maybe things that you weren't already aware of, but how do we unlock those? And then based off your cash flow requirements, we want to acquire assets. First, acquire assets that eliminate tax, reduce tax, or defer tax. So eliminate, reduce, or defer. And I mentioned acquire assets. Now there's cleanup strategies that aren't necessarily asset acquisition strategies or financial products, and we'll consider those too. But we never want to execute tax strategies that reduce our taxes, but impact the growth of our business negatively or our overall wealth. And I can give you a lot of horror stories of people chasing tax savings and they end up in a worse off position because they tied up all their cash and they now have to lay people off, for example. So that's sort of our strategy. Now, the reality is most people don't implement any tax saving strategies because they're stuck in this tax cash flow doom loop, which is that they don't have enough cash on hand to acquire assets or buy these financial products that would create a massive ROI for them, but they are not positioned to execute it. So they don't have their balance sheet in a position to execute it. They have a heavy level of skepticism, but they haven't done any research. So that's back to the person who's like, this all sounds too good to be true. I'm skeptical. You show them all the court cases. You show them all the IRS audit manuals and they're like, yeah, but my friends aren't doing it. This seems too good to be true. Or they're waiting until Q4. So most people do tax planning in Q4 when they sort of panic that what they still owe. And sometimes the products that they want to utilize, like something called medical LLC, for example, or leverage depreciation, are already fully subscribed, meaning the product is not taking on any other investors for the year. Or they just don't have enough cash to execute. Again, back to that tax cash flow doom loop. And so they miss out and they end up in this cycle where they're constantly having to overpay in taxes. So with that, no one's going to be graded on this, but if you could, in the chat, I kind of gave the answer to this, but when it comes to tax planning, what is the overarching strategy or the way that you want to use your cash? What is the overarching philosophy of tax planning? It's kind of a vague question, but I'm curious how you guys are going to answer. What's the overarching philosophy or perspective that you need to take with tax planning? You could just drop, see if there's any brave souls to try to take a shot at the answer of that. Use tax savings to achieve long-term wealth. Yep. Taxes should fund your future. Yeah, I agree with that. Let's see if we get one more. Start your planning early, lower tax liability while still increasing wealth. Those are all great answers. I agree with all of those. Maximize income production while minimizing tax drag. Yep. And I'll just add one more, which the overarching thing that we want to do is convert our cash into assets that will produce future cash flow, will grow in value, and generate a tax savings. So we want to convert income cash flow into assets that will grow in value, will produce cash flow, and result in tax savings. So that's the ultimate goal. And if we do all of that, then we lowered our tax liability, we increased our wealth, we're funding our future, we're preserving some wealth. So it sort of all connects back to things that you're saying. just kind of giving you the kind of tactical or the in the weeds of what we want to do. Now, before I hand it over to Kyle, when you say the tax cash flow doom loop is part of why most won't implement versus can't implement, are you implying that the doom loop is not real but rather perceived? Yeah, great question. It's certainly real. From my observation, this is a pattern that I see people in, that every year they pay the highest tax rate. And as a consequence of paying the highest tax rate and waiting without building a plan early, by waiting till the end of the year, they guarantee themselves that they will continue to have to pay the highest tax rate because they don't have the cash to actually execute. So, for example, I've got someone, and they can comment if they want, we just got off a call. They were very explicit about, I want to start my tax plan now. Now, most people wait until Q4. I want to start my tax plan now so that I have enough runway to ensure that I've implemented by the end of the year. And by getting a plan now, if we know, for example, that we've got the specific mix of strategies that you've signed off on, and you know that you're going to reduce your taxes by $200,000, as an example, then you stop making payments, quarterly payments, or you stop having anything withheld from your W-2 now, so that you have that cash to be able to deploy towards the strategies that would then result in the tax savings for you. So you need the plan and all the different options and the cash required and your effort and the due dates, so that then you can stop making the tax payments, stop having the withholdings from your check, so that you can reallocate it towards the actual strategies. Kyle, anything you want to add on to that or add any further clarity to?
That was really good. I think maybe the only thing I would add is you're far enough down that doom loop, then there is some immediate changes that have to happen budget wise, cash flow management wise, in order for you to get into the position where you can start that tax planning phase. And there's planning that has to happen there as well.
Yeah. So a good reasonable goal in May of 2025, if you haven't implemented, don't have a plan yet, is reduce my taxes this year by 50%. That's a good reasonable goal. There's more. You can reduce up to 100% depending on your situation, especially if you're a business owner. But this year, based off your cash constraints, which is why we want to analyze that, it might be 50%, but we position ourselves so that next year it's 100%. But you just got to avoid the all or nothing thinking that if I don't reduce it by 100%, then I'm not going to do it at all. And people get in that loop. And let me give a little anecdote that I meant to share. I've been having this recurring dream that I'm going up this hill in Seattle. If anyone's familiar, James Street, off the freeway up to Seattle, where I went to college. And it's this part of it's a very steep hill. But in my dream, it's this rolling hill. So it's steeper than it actually is. And I get just to the top, and then I slide all the way back down to the bottom of the hill. And some of you can psychoanalyze me here and why that's happening. And then I tried a second time, and usually I get to the top. But last night I had this same dream, and this time someone was in the car, and I get all the way up to the top, I slide back. They don't say anything to me, but I look over at them and I say, why do I keep going this direction? Next time, I'm going to take a different route that doesn't have this hill. And to some degree, as cheesy as this might be, a little bit woo-woo, that's what we're talking about. And sort of this tax doom loop is that so many folks with their finances, they almost get to the top where they can actually execute. They run out of time. They didn't do enough planning, that they slide back and they end up in the same position they were in. And what you got to do is I got to take a different route this time. There's a different path, and maybe you got someone else in the car that can tell you those directions. And really that's what we're trying to do for folks. All right. Maybe a little woo-woo, but in my mind, that was a great analogy.
That was good. That was good.
All right, let's get into the actual meat of things, Kyle. All right.
Cool. Thanks, Dan. So there's a lot in this bill. If you've looked at it at all, you'll know there's a lot that's tax related. There's a lot that's not tax related. We're going to focus on the things that are tax related. We're going to start with the things that are going to probably be the most applicable to the audience here. We'll want to touch on all the tax aspects too. So we'll go through everything. There was a question that came in. I'm going to touch on this one briefly before we jump into it. No tax on Social Security was not included. That's correct. There was talk initially of not taxing Social Security. That did not get included. We will cover a small bone that was thrown at seniors as part of this later in the presentation, but no on that question. All right, Dan, we can head to the next one. Okay, so Dan hinted at this already. 100% bonus depreciation, that's been talked about for the last couple of years as something that we wanted to see kind of coming back. And so that's a big part of what we expect to see here. So they're talking about extending 100% bonus depreciation through 2029. Again, what that means is a business that's acquiring assets that have a life of 20 years or less. So that could be equipment, that could be fixtures, that could be vehicles. If you're in real estate, it could be certain components of a commercial or residential real estate purchase that would qualify for that bonus depreciation. What it allows you to do is write off in the year of acquisition the value of that asset rather than spreading that out over 5, 7, 15 years. A couple of notes with this. So currently, bonus depreciation is on a phase down schedule. It was 100% a few years ago. Over the last couple of years, it's been trickling down. For 2025 under current law, it's 40%, which means 40% of those assets you acquire, you get to write off. This year, the remaining 60% is depreciated over the life of that asset. So 100% provides a pretty significant incentive for business owners to acquire assets because they get to see the immediate tax benefit for those acquisitions. Again, bonus depreciation applies to assets that have a 20-year or less recovery period or tax life. There are some special rules that will be clarified around certain production property that hasn't been formally baked out yet, but there may be there's a lot of incentives within this bill for geared towards manufacturing done in the United States. So we'll see that clarified. We want to tie this back to how can you use this information. So bonus depreciation is huge, specifically in the real estate space. So those real estate professionals who are acquiring traditional rental properties or commercial rental properties, this greatly incentivizes you to acquire new properties, especially if you couple that with a cost segregation study, because you're going to see a pretty significant immediate tax savings. For those that aren't real estate professionals, short-term rental options, short-term rental acquisition can unlock some pretty sizable tax opportunity for you as well. And so this is one of those aspects of the bill that is kind of broadly applicable. Also, again, as Dan hinted at, once this goes through and bonus depreciation is back at 100%, we're likely to see an uptick in competition in the market for real estate acquisition because people are expecting those outsized returns on those investments. So getting an early start on that acquisition process might be beneficial.
Yeah, two quick things. Question for everybody in the chat: who's been waiting for bonus depreciation to go back from 40% to 100%? I know this has got to be several of our clients in here who are ecstatic about this. I mean, this is huge. This is a huge thing. It makes reducing your taxes just so much easier if you're trying to get to 0% tax as a business owner or offset 500,000 of your income as a W-2. It just removes a lot of friction. Seeing several yeses. So this is huge. I'm gonna maybe regret this, but I'm gonna put my email in the chat here in a second. If anyone wants to get connected to a resource to help you buy a short-term rental, I've got a great vendor who's just crushing it. If you're looking for long-term rentals, have another awesome vendor who we highly recommend. We're not affiliated with any of these folks. We don't make anything from this other than our incentive is back to my politics of capitalism, of helping you fund your goals. So I'll drop my email in. I gave my schedule as well up here, and you can just email like, I want a connection to help me find a long-term rental, or I want a connection to help me find a short-term rental, and I'll connect you.
Cool. Thanks, Dan. A couple of questions came in specific to bonus depreciation, so I'm going to tackle those really quick. Somebody asked if they purchased a new pickup truck, would that qualify for 100% bonus? If that vehicle is used exclusively in your business, then yeah, vehicles will continue to qualify for bonus depreciation as well. The rules around expensing vehicles haven't changed, just the bonus depreciation rate has changed. So no change to the law, you'd write off 40% of that pickup truck this year. With the change to 100%, you'd have the opportunity to write off 100%. Right now, there's nothing in the bill that says we can carry this change back to earlier years. Right now, as it's written, this would apply to purchases that are happening in the 2025 calendar year, specifically those happening after January of this year. So if you acquired, this is a couple of questions here. If you acquired real estate this year before the bill is ratified, but after January of 2025, the 100% rate should apply under the current draft. Okay, I think we can close off to the next one.
Yeah.
Another big one is R&D expensing. So if you have followed at all the drama around the R&D tax credit specifically over the last few years, you are probably up to speed on this, but a few years ago, 2022, a rule specific to businesses engaging in research and development costs in projects expired. A rule that had been in place since the 80s went away that said, hey, if you are spending on research and development outside of normal business operations, research and development costs can't be expensed the same way as you would expense ordinary operating costs. Instead, you have to spread those costs out over 5 years. So similar to depreciation that we talked about before, if we go and we spend $100,000 on some research project in hopes of developing a new project or product, we would have to take that $100,000 and spread it out over 5 years for deduction instead of deducting it all at once. That law was terrible. Nobody liked it. It kind of worked against incentivizing businesses to engage in U.S. research. So this will fix that, essentially. It will allow businesses to once again write off R&D costs, and this rule would be in place through 2029. It only applies to domestic research. So if you are spending overseas for research and development, if you're having, a foreign agency develop an app or some software for you, that actually has to be spread out over 15 years. So this really incentivizes businesses to spend on U.S. R&D. But by changing this rule, businesses are going to be more incentivized to go after the research and development tax credit. The reason that businesses have pulled back from the tax credit over the last few years is if we claim this R&D tax credit that exists, we're sort of throwing our hands in the air and saying, hey, I have R&D expenses. So then the IRS is going to look for you to capitalize and spread out the costs for those R&D expenses, which in practice, what we've seen is businesses that have a high amount of R&D costs, this change actually will result in a pretty massive reduction of their deductions or their expenses and create some immediate tax burn over 5 years. They come out okay, but in the short term, it can sting pretty bad. So what does this mean for people? It means that the R&D tax credit is back on the table, and it should be something that anyone who's engaging in the development of new products or processes that involve US-based labor, this would be something you'd want to look at. Scientific in nature, new products or processes. And then really consider that impact on foreign research. Since we won't get to deduct those costs immediately, we have to spread them out over 15 years. That could have could make US-based labor more attractive when it comes to R&D.
Kyle, does this fix prior years?
Doesn't fix prior years. Right now, the rules as it is in the bill would only apply to 2025. So we'll see, because that has been something there's been a lot of effort behind, is to push this retroactive. So our hope is that we see something in the revisions that might carry this back.
Okay. Yeah, so we'll keep our fingers crossed that for prior years, the Senate's going to fight to fix the credit for previous years. It was a bipartisan issue for the last couple of years, so we'll see if that comes through. The question around does this qualify for you is, are you developing a product or process that's technological or biological in nature, and have you undergone any process of experimentation? So if you think maybe you've developed a new product or process and it's technological or biological, I think 48 different industries apply here. Hit up my calendar link and we can chat for a few minutes, and I can direct you to some resources to at least get an estimate of what the potential tax savings would be for you.
Yeah.
All right. SALT deduction. This is another one that we've been wanting to see fixed.
Yeah. I wouldn't say this is a complete fix, but it's definitely a big move in the right direction. So those of you that are in states where you pay a high amount of state income tax, you probably felt this back in 2017 when the Tax Cuts and Jobs Act passed. But historically, individuals could write off any amount of state and local taxes that they paid as itemized deductions on their personal tax return. There was no limit. With the Tax Cuts and Jobs Act, they capped that SALT deduction at $10,000. So it didn't matter how much you paid to your state and local government for property taxes or state income taxes or sales tax or the like, you couldn't deduct more than $10,000. That left a lot of taxpayers paying a lot of tax they didn't really get any benefit for at the federal level. So one of the changes that they're going to push through here with this is to increase that threshold from $10,000 to $40,000. So now we have a $40,000 threshold. That gives us a lot more room to see an addition to our itemized deductions, get more benefit. If you're above the $40,000, you're still going to be subject to a limitation there in your deduction opportunity, but $40,000 is a lot higher than 10. There is a phase out that happens. So once your income exceeds 400,000, you're going to see a potential phase out of your deduction opportunity on that 40. What that exactly looks like yet is still up in the air. There is some increase planned between now and 2033 for 1% annual increases to that 40,000 to kind of keep up with inflation. And then the other change is that we make this cap permanent rather than temporary. So the $10,000 cap that was in place was temporary. This 40,000 increase would be permanent, which means it's going to be more difficult to change it in the future if there's efforts to do that. There have been a lot of workaround strategies created over the last few years in certain states to allow, for example, business owners to opt to have their business pay their income tax at the state level instead of the personal level so that they can get that deduction. There is some effort in the bill to make those strategies void. And so, again, we'll monitor that to see how that impacts various state election opportunities.
Yeah, two things I want to highlight here. One, when this was going through the House, there was a lot of friction on what the cap should be, 30,000, 40,000. So this one is potentially subject to a lot of wrangling in the Senate. So we'll see where this one lands. But what I want to, so that's the first piece. The second piece I want to highlight is there's the deduction phases, gets limited as you get over 400,000. And you'll see this with other strategies. So the point is we want to get our taxable income below this threshold, which then allows us to qualify for additional deductions. So this is sort of a theme of if I can get my income below a certain threshold, then automatically I qualify for deductions that I've already paid for. Or all of a sudden now I qualify for credits that would otherwise phase out. So there's a multiplicative effect as we reduce our income that it makes it easier for us to qualify, which then in return reduces our tax liability even further.
Yeah, exactly. Thanks,
All right.
Dan. Last one on kind of the big ones is green credit elimination. So there's a lot of credits that exist currently to incentivize investment in clean energy. There's electric vehicle credits, credits around charging infrastructure, home improvements, etc. These credits are set to expire. They want to cancel those in 2025. Originally, they were scheduled for a phase out over the next 6 years. So what does that mean? It means if you are somebody who is on the fence or was planning to invest in electric vehicles or other kind of clean energy projects, doing so before the end of 2025 probably makes the most sense if you want to capture those credit opportunities because they'll likely be gone next year.
Yeah. All right. So let's drill down into a bit more some of the business specific strategies.
Yeah. So Section 179, you may have heard of this is sort of a competitor to bonus depreciation. They often get referred to as the same thing. They're not. So bonus depreciation allows us to drive our taxable income below zero, whereas Section 179 would only allow us to drive our taxable income to zero. But what this change would have is we essentially double the amount of Section 179 opportunity that a business has. So the limit previously was around 1.25 million. I'm sorry, 1.25 million. It's now going to be 2.5 million. So, sorry, I just got to grab a drink of water. Businesses that are spending heavily on assets would have more opportunity to write those off in the year of acquisition. So similar to bonus depreciation, Section 179 allows us to fully write off the value of certain assets in the year of acquisition. There would be a phase out. So when the value of assets purchased exceeds 4 million, we start to see a reduction in the amount of 179 that a business can write off. So there's sort of a sweet spot where this would apply. Those thresholds and those amounts are going to be indexed based on inflation over time. And there's no change in what type of assets qualify for Section 179 here. So the definitions within the deduction are remaining consistent. We're just seeing a change in the amount allowed. And this, again, would apply for property that's placed in service after 2024. So essentially anything placed in service in 2025 or later. How does this impact you, or how might you leverage this? Like I said before, this is sort of a competing strategy with bonus depreciation. And so whenever we're looking at asset acquisitions, one thing that we do through planning is we always optimize between those two strategies to figure out which one is going to be best overall given somebody's situation. One simple thing is a lot of states don't allow bonus depreciation. So they would have you depreciate your asset over its normal life. So when we see then is that somebody may see an outsized deduction at the federal level, but they may see a more nominal deduction at the state level. So more states allow Section 179. And so in some cases, it makes sense to opt for the Section 179 deduction at the federal level because the state will allow that as well. And so again, it's case by case, and we have to kind of optimize around those opportunities.
Yeah, it's a good point. We're just talking about federal tax. Not every state conforms to the federal tax rules. So you got to run multiple different scenarios based off your state tax rules and federal rules to come up with the most optimized blend. So it's not getting any easier. Back in 2003, when I got in the game, as they say, there were 82,000 state and local governments. Now there's somewhere north of 89,000 state and local governments here in the U.S. So the complexity is certainly not decreasing. All right, let's talk about manufacturing. And I don't know that we have very many manufacturers here, but drop a comment if you're a manufacturer.
Cool, thanks, Dan. Yeah, I'll breeze through the manufacturer. It's like you said, not a lot of our people in this space, but this applies to manufacturing facilities. And so if you are building a manufacturing facility or enacting major improvements on a manufacturing facility, then the bill would actually allow for 100% immediate expensing of that that acquisition or that or those improvements. So this is even better than the real estate stuff we talked about before, because here we can even apply that 100% deduction to the building component, which generally would be expensed over 39 years. Instead of a 39-year run, we get to take that expense right out of the gate. This is going to be an area where there's going to be a lot of clarification that comes, because there's room for this to be interpreted different ways. But one opportunity that exists right now, and where we'll definitely be spending some time, is looking at the ability for real estate professionals to invest in commercial facilities that are manufacturing facilities and see if we can capture those tax savings there, even if the individual themselves is not engaging in the manufacturing them and is maybe leasing the building out to a manufacturer. So there's likely a lot of opportunity in this space. Again, a lot of what's here is driven towards bringing manufacturing into the United States. And so we see some pretty heavy opportunities weighted in that direction. Anything you want to add to that, Dan?
I think it's just a good consideration around how you might shift your real estate strategy.
Yeah. Cool. We'll just cruise on. All right. So small business threshold increase. So there's a lot of tax laws that apply to businesses in general. And then there's this carve out that says, hey, this law doesn't actually apply to small businesses. And previously, a small business was defined as a business that had gross receipts under $25 million. So most businesses in the United States qualify as small businesses. This applied to things like being able to opt for the cash method of accounting over accrual accounting, being able to expense inventory rather than track inventory, some more complex UNICAP rules I'm not going to get into, but apply to large businesses, and then also some business interest limitation adjustments. So what they're doing here is they're going to increase the definition of a small business from $25 million to $80 million in gross receipts, which means even more businesses are going to qualify as quote unquote small businesses, and then be able to leverage these types of elections to simplify the administrative burden of the kind of record keeping and accounting. And these also often open the door for the acceleration of certain expenses, deferring certain revenue. And so quite a lot of opportunity here for businesses that might be above that $25 million income level to make some changes that could have a pretty material impact on their tax liability in the short term.
Yeah. You know, I'm just reflecting on this one. I hadn't thought about it much beforehand, but you see a line item like this and it's like, oh, this doesn't seem like much, but we have somewhere north of 150 different strategies that we might consider for a client. It doesn't mean you qualify for 150, but just a database of options. And so things like Section 179 being expanded, or bonus depreciation expanding, or the small business threshold, they sound like one thing, but it impacts 10, 20 different strategies in terms of the applicability and just the breadth and depth of what you can do with it. So if you're thinking like, well, I'm not sure if this or 179 applies, or bonus, or some of these other things, it's like there's multiple different planning strategies that it indirectly is expanding that maybe you didn't qualify for and now you do.
Yeah, absolutely.
All right.
There's a lot of individual tax provisions, so I'm going to try to cruise through these. So feel free to drop questions in there if anything comes up. But a couple of these are consistent with what we planned before. Just a continuation of some reduced tax rates. So we're not going to go back to the pre-Tax Cuts and Jobs Act tax rates that were set to come back in based on some expirations of things. We're going to keep the current reduced tax rates.
Yep.
The standard deduction enhancement. So this is a slight change. The standard deduction over the last several years, again since 2017, has been essentially double what it was before, meaning as individuals, the amount of deduction that we all qualify for was quite a bit larger than it was in those pre-Tax Cuts and Jobs Act days. What they're talking about here is to even bump that up a bit more temporarily, add an extra $1,000 to $2,000 deduction above the standard deduction for the next 3 years, or sorry, for 2025 to 2028, and then have some minor adjustments for inflation as well. What does this mean for people? It just means that the standard deduction is high. So when we're looking at our itemized deductions and we're adding up things like state and local taxes, mortgage interest, charitable giving, deductible medical, those types of things, it's a higher threshold that we have to cross before we're going to actually see any marginal benefit for spending in those areas. So we want to make sure we've optimized our itemized deductions. And again, that's a planning thing we look at for people. Child tax credit enhancement. This is a big change too. So the child tax credit has been $2,000. Historically, it was $1,000, and they're talking about increasing it again temporarily for 2025 through 2028 from $2,000 to $2,500. That means possible credit of $2,500 per child that will be available. There are phase outs on this. So high income earners generally phase out of being able to take advantage of the child tax credit. So again, going back to what Dan said before, as we drive taxable income down through tax strategy, if we can get below those thresholds, people with children automatically start to qualify for these dollar for dollar tax credits. You know, if you have 3 children, $7,500 of tax credit you qualify for immediately if you can get your income down below that threshold. All right, a lot of questions about this and the next one, but no tax on tips. So this has been included. There's been a lot of talk about this. Essentially, what it means is those that are in traditionally industries that qualify for tips. So a lot of food and beverage. They're also including beauty services in this, which is great. Tips, whether paid through credit cards or cash, would be exempt from income tax. So this impacts individuals who are receiving tips, but good benefit. Where there's something really unique here is that change around beauty services. So business owners that are in tipping industries, you probably are familiar with the FICA tips credit, which essentially says if you run tips through payroll, the business is going to pay employment taxes, FICA taxes, on those tips to the government. The business qualifies for a credit, a tax credit, based on the FICA taxes paid on those tips. Historically, that credit was only available to food and beverage employers. It's been an issue since like the early 90s that beauty services have been pushing to say like, hey, tipping is very common in our industry as well. We should also be able to take advantage of this credit. This is allowing that. So kind of finalizing that battle that's been going on for quite a while. This could be huge for those that are in health or hair care, barbering, nail care, aesthetics, body and spa treatments. And so for spas specifically, you can see about taking advantage of this FICA tip credit. Could be a pretty massive tax credit opportunity for employers in that space.
Thinking of one client that has many tens of thousands in FICA taxes that they're paying on tips that they have not qualified for until now.
Yep.
So yeah, this is significant.
Very significant. No tax on overtime. So there was a question about this. Yes, no tax on overtime is included in the bill. Now, just to clarify this a bit, there's no tax on the half portion of time and a half. So an individual would still be taxed on their ordinary wages, but what they're saying is if you are being paid time and a half, then the extra chunk, the half, is excluded from tax. So that's a clarification I haven't seen really advertised very much, but that's there in the bill. This does exclude highly compensated employees, and currently the highly compensated employee threshold is somewhere around $200,000 in compensation. They may clarify that further through guidance on this, but that's about where that threshold is. And so how does this impact businesses? Employees who may be resistant to overtime. Overtime might be more attractive for a period, but then there might be a snapback at the end of the 2028 when this law is scheduled to go away. If it's not continued, then the opposite might be true. People may be more resistant to overtime because they're losing that incentive.
Yeah. All these temporary provisions, that's when you sort of get back into the political machinery of it all and the ways in which timing is set up based off election cycles and otherwise. So unfortunately, that is part of the game here that we have to kind of just be prepared for.
Cool. We missed a question here. So there was a question about Uber drivers and other delivery services. Those would not be included in the tips exclusion. It's limited to food and beverage and beauty services as of now.
I think there's a separate provision about gig economy.
There is a bit about gig economy. It's specific to reporting, but we'll touch on that here in a
Gotcha.
minute. Okay, here's the bit that I talked about. Senior tax relief. Again, it's not a major change, but they're talking about a $4,000 above the line deduction for seniors. What that means is if you're above 65 and your income, if you're single, is below 75,000 or joint filer below 150,000, you would qualify for this $4,000 deduction.
Yep.
Not
much there. Yeah.
Auto loan interest deduction. Again, this is one there's been a lot of talk about. It's a temporary change, 2025 through 2028. Saw that same timeline on a lot of these. What this would allow for is a $10,000 deduction for auto loan interest, and auto would apply to cars, minivans, SUVs. Also applies to things like ATVs and recreational vehicles. There are income phase outs on this though. So if you're single and you're above 100,000, or if you're a joint filer and you're above 200,000, you're going to see that deduction phases out. And so really this is geared more towards kind of lower income, not low income, but lower income levels, and to provide a bit of additional relief on auto loan interest. Similar to the strategies we talked about before, this can also apply to higher income people. If through strategy we can drive your taxable income down, then we can add on this bonus of being able to deduct any auto loan interest that you're paying.
So when you stack up the auto loan interest deduction and the child tax credits, if you have kids, you can conceivably get to zero tax due without having to get to zero taxable income once you get below certain thresholds. So when you're in that 100 to 200,000 range, potentially you can still get to zero. So we talked to a lot of W-2 earners who say make 700 grand. They're allowed to reduce their taxable income to 200 grand. So you can take up to 500,000 in losses from real estate or a business. How would you get those losses? Well, you could use bonus or Section 179. So it just got easier to do that. Get down to 200. Now you've qualified for some of these other strategies that potentially could get you the rest of the way or pretty close to zero. And then the question is, what are you going to do with that extra $200,000 to $300,000? How is that going to change your life? Have you acquired assets? Like that second part is the cool part to me. It's like, what does this actually do to change your life?
All right. QBI, so it's qualified business income deduction. This is that 20% pass-through income deduction that was put into place in 2018 with the Tax Cuts and Jobs Act. They're going to temporarily increase that from 20 to 23%. So more deduction opportunity. They're going to modify the phase outs a bit. The phase outs are quite complex, so it does require some strategic optimization around this. Nothing we can tackle here, but there will be some adjustments we have to contend with. But yeah, so one, this is being extended. The QBI was scheduled to expire here. It's going to be extended, and they're going to increase it slightly. Trump accounts for children. So this is a new type of savings account that they're talking about creating for children. For children born between 2024 and 2028, the government is going to fund this with an initial $1,000 contribution. From there, parents can contribute up to $5,000 per year to the account. It can't be accessed until the child reaches age 18. Other than the bonus of the $1,000 contribution, this is similar to other types of like education savings plans that already exist. The one difference here is that this plan is allowed to be used for education, but also entrepreneurship, business startup, and home ownership, so acquiring your first home. So it could be a nice alternative to other types of savings plans that exist for children.
Right.
A couple other provisions.
Yeah, we're down to some of the technical points here, so let's go through these couple reporting things quickly, and then
this will be really quick. So you talked about the gig economy thing. All this really says is this has to do with the issuance of 1099-Ks. So if you're collecting payments or processing payments through an online marketplace like PayPal or the like, there was a change that said if you're going to get a 1099-K if you process more than $600, that was administratively quite a headache. And so they're going back to a threshold that looks at whether you have more than 200 transactions or process more than $20,000 before that 1099-K is going to be issued. No planning opportunities here. It's just reporting. Similar thing here. So this has to do with 1099 reporting requirements. Historically, if you as a business made a payment of $600 or more, you had to consider whether a 1099 over the course of the year. You had to determine whether a 1099 needed to be issued to the recipient of that payment. They're going to increase that threshold from 600 to 2,000, which again just minimizes the paperwork requirements.
All right, so I think that was the last one. Would love to hear in the chat again if you guys have a tax change that you're most excited about. Is it bonus depreciation? Is it R&D? Is it Section 179? Is it the SALT tax increases, the kids accounts, the fact that it's probably, we don't have to get to zero now taxable income to potentially get to zero tax due. So which if any are most exciting to you, and why you think about that? Just sort of wrap up for those of you that aren't already doing planning. Don't let this be you. Don't sit on the sidelines until the bill is finalized. And we don't know when the Senate is going to take action, but it's more likely than not that there's going to be a tax bill. And at a minimum, we're going to see bonus come back. We're going to see 179 expanded. R&D will be fixed in some capacity. So the longer you sit on the sidelines, the possibility, especially in the real estate side, where you're just going to have to pay more. Try to avoid that tax cash flow doom loop, which means you need a plan sooner than later. You need to see all your different options, know what the cash required is. You can legally, ethically pay no tax. So I know some people are skeptical. You don't need to hide your money in foreign bank accounts. I mean, we just gave some examples of strategies. Bonus already exists. Section 179 already exists. Like, all these things already exist. They're not as favorable, but these strategies are already out there. And don't put off putting together a plan until Q4. You miss out. We didn't even talk about financial products that are out there that oftentimes get subscribed before the year is up. I'm thinking like medical LLC as an example. That's not a preferred initial strategy, but it is something that can be a final thing to add in. And those get often fully subscribed by around Thanksgiving. So don't wait. I'll give my calendar link again for those of you that are live that you want to grab 15 minutes. There's no cost, just people helping people. And then again, my email address, if you want a connection to one of the people we work with really closely on the long-term rental acquisition side or the short-term rental side, we get zero compensation for this. So it's not a moneymaker for us. We're not affiliated. Otherwise, Kyle, I got to get on another call, but you're co-host, so if I don't know if you can stick around for a few more minutes to answer questions.
Yeah, I'm happy to. There's a couple of questions that we didn't get answered, so I'll get those answered, and feel free to drop in any additional questions and make sure those get answered before we drop off.
Awesome. Well, appreciate everyone tuning in. We'll keep doing these webinars as we get more and more information. So check out your email, different social accounts and stuff. We'll keep you updated there. Otherwise, Kyle, talk to you soon.
Cool. Thanks, Dan. There was a question in the chat. I think Zoom deletes it when the person logs out, so maybe that question won't get answered. But there was a question here: if we buy a long-term rental for $250,000 with a land value of $50,000, can we write off 100% of that price on everything that depreciates in 5 years or less? Great question. So I'll just break that down a little bit. So if you buy real estate and you qualify as a real estate professional, then we can utilize any losses that are generated, tax losses generated within that rental activity, to offset other types of income that you have. So the way we maximize our deduction opportunity with a real estate acquisition is to utilize something called a cost segregation study. So let's use $250,000. If we buy a property for $250,000, the first thing we have to do is say, okay, what's the value of the land that property is sitting on? We don't get to depreciate land. Land just exists forever, so we carve that out. So we're going to carve out the $50,000 of land. Now we have $200,000 that's allocated to the building. Traditional depreciation would have us take that $200,000 and we'd recognize it over 27 and a half years. We'd get 1/27th essentially of the purchase price of the 200 each year as a deduction for the next 27 years. That's not really going to get us anywhere fast. So what the cost segregation study does is it has an engineering firm come in, they analyze the building, and they break it up into the components that make up that space. Because when you buy a building, you're really buying the fixtures, the lighting, the flooring, the appliances. There's a lot of stuff in that building, and a lot of it has a life that is less than 20 years. So what the engineering firm does is they say, hey, this 200 grand, 5,000 of it is lighting, 5,000 of it's the HVAC, and so on and so forth, until they've allocated as much of that cost into other assets as they can. We still have some chunk that is the building itself that we depreciate over 27 and a half years, but a lot of the assets are going to be 5, 10, 15-year property. To the extent that the cost is bucketed into those short life assets, those are the ones that are eligible for bonus depreciation. And so usually what we see is somewhere around 25% of the purchase price can be bucketed into those short life assets. And so if we buy, I'm just going to use a different number. So if we bought a property for $1 million, we might see $250,000 of that that's eligible for bonus depreciation, which means a $250,000 immediate write-off under 100% bonus. With 40% bonus, which is where we're at today, you'd only get 40% of that 250, which would be a much smaller chunk. So that's why real estate acquisition is going to be so competitive here once bonus depreciation is returned to 100%, because there's a huge opportunity for tax savings in that area. Let's see. Looking at the questions here, there's a question about sovereign tax credit purchases. There's nothing in the bill specific to sovereign tax credit purchases. If sovereign tax credit purchases are clarified by Congress and by the IRS, that'll come separately. There's a question here. What about using capital expenses like expensive equipment for a company? Can a cost seg or bonus depreciation be used? Yeah. So bonus depreciation applies to any business assets that are acquired that have a life of 20 years or less. The reason we focus so much on real estate is real estate can be an area where you can get an outsized return on your investment because of the ability to leverage a mortgage. And so you can, let's use the $1 million purchase scenario. You might come into that purchase with 200,000, 20% of the million. So you've got 200,000 in, And with the cost segregation and the bonus depreciation, your $200,000 investment might help you see a $250,000 deduction. So you're actually getting a deduction that exceeds your cash in on that investment. So that's why real estate is unique. But the same would apply in a normal business. So if we had to go out and buy like a $50,000 piece of equipment for our business, 100% bonus depreciation allows us to write off that entire $50,000 in the year that we purchase that equipment. And that applies the same whether we spend $50,000 of cash to buy the equipment or we take out a loan to buy that. It's treated the same way for tax purposes. Does that answer the question? Anything further on that piece or any other questions before we wrap up here? Cool. Okay. Well, again, thanks everyone for tuning in. Hopefully you got some answers here that were helpful. We'll continue to stay on top of things as there's additional changes or clarifications, and we'll share that information out as it becomes available. Thanks so much. Have a great rest of the day.